Can you hear me? All right. So I'm going to begin with the opening and then the analysis themselves. So the AI revolution is booming, but with rapid expansion comes unique challenges. Rising construction costs, escalating energy demands, and increasing project complexities are pushing traditional investment strategies to their limits. This leads us to our million-dollar question. How can investors successfully adapt and capitalize within this dynamic landscape? On this panel, we will talk about key investment drivers, evolving risk-return profiles, new and emerging markets, and innovative investment strategies. We'll also build upon themes from previous keynotes, specifically considering the profound impact of artificial intelligence and how might AI breakthroughs intersect with these capital market trends and reshape the future of investments. So let's begin with the experts who will be guiding us through these topics, and we'll start with David on the very far end.
Hello everyone, I'm David Smith. I'm the Chief Investment Officer of National Data Centres. Echelon is a developer. We're active in the UK and Ireland and expanding into continental Europe. We have operational data centres in the UK and Ireland. We control about 2 gigawatts of capacity across the markets. Prior to Echelon, I was Managing Director in Data Centre Investments at our Capital Group, and where I spent 9 years. So it's great to be here to speak to everyone.
Joanna Veska, Managing Director within the Infrastructure Energy Capital Division of Macquarie Capital. We are the Principal Investment Division of Macquarie Group. I take a specific lead on our digital infrastructure investments here in Europe. Digital infrastructure now the largest part of our balance sheet with 13 investments globally. On the data center side, we have 3 investments, one data center in the US, Heavily and joint venture with NTT in Europe, as well as a couple of fiber assets as well. Likewise,
Yeah, hi, so my name is Tom Roberts, I'm the CEO of Talk Partners. We're not a capital operating banking place, capital where in the investment banking space we started off our sort of journey on data centers market about 20 years ago. When it was not fashionable, most of the businesses were, on their knees, probably, about to go bankrupt or had gone bankrupt and risen from the ashes. And we started off doing effective consolidation transactions in the European context, and then, more recently, spending more of our time doing Hyperscaler projects, which is kind of when the scale is really ramped up. And so we're doing that primarily in a European context, but also more broadly, so references that we've worked on Green Mountain, Terrico, Fleet, Tract in the US, and various events here as well.
Perfect time.
Sorry for being late. I was meeting 17 years ago, preparing my notes, but sorry for that. Donc j'ai écrit à digital infrastructure for the team at Arno. Arno is a private equity firm. We manage 180 million of asset under management, out of which 35 billion within the infrastructure bucket. And within the infrastructure, we have just 3 verticals of investment: digital infrastructure, energy transition, and transportation. And I'm leading digital infrastructure for the team in Europe. We have been investing throughout the whole value chain from towards cyber and also data center. We have one platform in Europe which is historically very focused on Nordic, expanding also into Europe, which is called Vail. This is the platform we built last year, a bit more than 12 months ago from sector, and we get the right capital to fund that growth. And now we are expanding, and we are also looking at one platform in the US where we are in the next stage.
Great.
My name is Ellen Hall. I am the head of direct real estate for Fidelity Investments based in Boston. I essentially assemble and manage private equity funds for Fidelity investors in direct real estate. I have 2 data center funds today that we're running through Fidelity affiliate that some of you may have heard of, Colt DCS. Colt has been active in the data center space for more than 10 years in Europe, Asia, and now.
I'm Miles William from New York. I started the very first data center valuation practice in this industry about 25 years ago. I built a team of about 12 people, and we cover 6 continents. In the last 12 months, we've completed over 1,000 valuations. That's over $100 billion in valuations in the last 12 months. So, well, thank you very much. I see everyone prepared here. I feel really bad because I didn't look at the website with questions. I made up my own questions. So we don't have enough time, so we're going to do kind of like rapid fire. So we'll just ask you each questions, and if you can just quickly answer, we'll move to the next question. Okay? So let's start with the investment drivers. Let's begin by examining the forces driving investment in the data center market. The demand for capital is clearly surging, but what specific trends are emerging, and how are they shaping investment priorities? So let's start with you, Ellen. Ellen, having led real estate and digital infrastructure investment at major global firms, you have a unique perspective on the data center market's evolution. While M&A have been a dominant theme, how has today's market volatility from power constraints to supply chain concerns has impacted M&A trends and investment priorities? And when it comes to strategy, what should buyers and sellers be looking at right now?
It's a big question. I would say in terms of the high level, what's really driving the theme is certainly the adoption of technologies like AI, automation, cybersecurity. They're all pushing companies to invest heavily in digital infrastructures. There's a need for capital. Not only is on the technology side, but certainly on the data center space to support all of those applications. I think that we're seeing some sort of stabilization in the economy with a deregulation in the US, which is also starting to drive M&A, just making it easier. And then certainly, there's just a ton of investor interest from large-scale private equity infrastructure funds to retail investors like we have. Everybody wants exposure to the sector, and I think that's driving a lot of the issues right now.
Great, thank you. Giovanni, Macquarie Capital has a global footprint. Following on M&A drivers Ellen mentioned, with increasing geopolitical fragmentation and varied approaches to data center sovereignty across Europe, how are these factors influencing where significant capital is being directed for new data center builds? And what premium, if any, are investors placing on markets with clear and stable data governance?
Yeah, we've seen a transition, particularly over the last 6 to 9 months, in terms of the way that, let's say, Europe is responding to the Trump administration and has emerging. Especially it's going to focus on localized and sovereign clouds. There's also been, on the flip side, some of the large cloud players being quite circumspect as to which markets they choose to deploy in and where they're focused on, depending on how favourable or benign the governance is in relation to GDP and other factors as well. What we try to do is, through our platforms, take quite a localised approach in terms of trying to pick the markets, where there are going to be emerging to local champions, and see how we can play a role in terms of facilitating digital infrastructure to support those local champions. But we've seen as notices in the market and a bit more circumspect approach to the large players as they approach like a fragmented market, which Europe is.
Okay, Tom, Torch Partners says AI driving growth across data centers, software, and technology sectors, which is a transformative shift towards a distributed infrastructure. The opening session highlighted AI's impact on data center economics and questioned the pivotal role of energy resources in sustainability and effective navigation of geopolitical hurdles. Given Torch's focus on digital infrastructure, how is uncertainty surrounding AI's future trajectory impacting your investment strategies and risk assessment?
Yeah, great question. Look, I think this is more on the panel. I think when we look at the projects that we work on, we try and assess, what is that impact of AI and how's that going to, power that forward. I think we've got to work out what is the workload that is going to be in the platform. I think you need to then think about where is your platform in the European context. context. I think we are pretty cautious of being gung-ho to think that the AI training models are going to land in this market in the European context. And the rationale for that is that, if you're OpenAI, if you're Stargate, if you're Microsoft, AWS, you've got all your skill set in the US. You're going to deploy your 1 gigawatt or 2 gigawatt campus in that market. There's lots of power, it's cheap, you get regulatory support, you get subsidies on power, you get subsidies on the land. So I think if we think from a dollar perspective, the US is going to be the place where most of that AI dollar goes from a training perspective. But then I think what we're looking for from our perspective, the European context, is what proof points we can see coming through on the inference side. And people talking to, there was a kind of question from the panel in the past, which was talking about is latency important for instance, training. I think actually latency has zero impact today on your AI activity response. It's all compute queuing. So the thing that takes time is not the latency, it's just because the resource queuing for your search or your image generator is just waiting to be processed. So no one can tell today, whether it's the inference, the latency sensitive or not. I think so you've really got to spend time unpacking the AI workloads.
Okay, thanks, Jeff.
If I may add, I think what you say in the market, which is stable, at least on the geopolitical environment, I think it's pretty right where most of the initially historically most of the demand for compute were in the US. Now with a lot of uncertainty every morning to get from the US, I think we are seeing more and more large hyperscaler and GPU service developing their platform in the EU. So I think we depend on the case by case. So we say, okay, I push Europe, I want to new countries, I want to get factory and so on, and some okay, I think to be better. And that will be counterbalanced by what has the European Commission and the various states wants to do. We see a push from the European Commission by I think 3 over the next 7 years. That's the actual capacity in Europe. So I think in a world of instability, I see a chance for Europe to go such indicators.
Yeah, I think that's 100% right. I think definitely pre-Trump tariffs and post, I think pre we were much more, hey, we'll just have some infrastructure to take in the US or to Azure. I think today, particularly we have, especially when we talk to near cloud providers and anybody who's got a data footprint or a regulatory footprint, banks, universities, they absolutely do not want to have all that infrastructure in Europe as well.
This is a good segue for capital decisions. So let me ask the next question to David. David, as an operator at Echelon, you're making major capital decisions. So AI's demand for extreme power clearly involves major capital decisions and trade-offs, right? So first, how is Echelon balancing the pressure for speed to market against the risk that today's cutting-edge infrastructure might be outdated in 3 to 5 years? And second, how does the specific risk of outdated or stranded assets in the near term influence your capital allocation for AI versus traditional ones? And how do you communicate that risk tolerance to start with?
That's a great question. It's 2 questions, 3 questions actually. So in terms of capital allocation, I think that's really important. So, we've seen a lot of noise in the market over the last several months around customer appetite or pullbacks or accelerations. So what that means is, you rightly pointed out, eating up the critical path is very important for our customers if we're delivering for credibility. But if you have a delay in terms of your anticipated timelines, because we're all using quite a lot of very creative financing for these projects, which generally get put in place once the SLAs are signed, You still have to order the kit, you still have to go through the design work, you still have to progress your sites. And that means you have to have a lot of equity capital available to do that. So analysts picked up on some of these things earlier on. I do think we're going to see a movement over the next several years towards better capitalized platforms because these projects are becoming bigger, because the customers are more cognizant of the counterparty risk with us as operators. We spend a lot of time speaking to them about those things. So having access to some more equity capital is really important, so that if there's an extra 50 or 100 million equity that's required to continue to get that critical path, we can go and do that. In terms of the second question around obsolescence, again, a lot of what we think about is location, and certainly at Echelon, the way we think about our business is we are very much focused on the cloud as an underlying driver of demand, which we feel very good about over the next 10 plus years. But we have a very, very strong skill set around AI, around large scale land development, around power procurement, around building power assets. So that plays very well into some of those larger training commitments. For me, coming from an investment background, I think it comes down to what is the type of bet that you're making. Yeah, so if you're obviously going to pay more and take more risk around something which is an established location and availabilities and those are adjacent. If you are doing something which is in a secondary or tertiary location, you have to have the appropriate capital allocation to make that work. It has to be within the portfolio of risk that you're taking. And that can be very, very accretive, but we need to be appropriate about it. Those considerations are the way that we speak to our banks and we speak to our equity holders about those items.
But just to pick up the point that I think you mentioned, I think obsolescence, it's not quite the right way to think about it. My mind is you've got, if you're building a piece of infrastructure, you're building it for your clients, they have defined it. Now, if their tenure of contract is 3 years, you've got that obsolescence which you've got a relay if they walk. But if you're building it for Hyperscaler, they're hopefully giving you a 15 plus 15. And if as long as your infrastructure is maintained in the right way and their workload is the right way, then they will simply renew for the next 15. That's the bet you're taking. But I don't think, you're spending hundreds of millions of equity capital for a customer who doesn't give you that. So the obsolescence is really the question.
Yeah, I think one way to think about it, if we take very sort of traditional real estate approaches, what's the value of the dirt? For us, I think the value of the dirt is not just the dirt in terms of the locations that we're operating in, it's also the value of the power. And that is the biggest constraint in the markets that we operate in. And how do we navigate that? How do we enter into joint ventures with real providers? That's going back to maybe 20 and 30 campuses, which are 70 kilometers out of the constraints of the metro. So being creative around that, but having a lot of confidence that when you're creating critical infrastructure for some of the highest growth, highest credit quality companies in the world, that is going to continue to be critical infrastructure for a long time.
We need to be good students. I think we are underestimating the grade on the value facility. And I think we don't have the history in that sector, or a long history that we work in towards observation infrastructure assets. And great on facilities will be driven by new technology, and so new technology are not perfectly developed today. So we need, let's say, this is a business where there is strong industrial value that is brought by the operator, and that will allow to maintain the asset with the best in class for them.
Before we move on to the next topic, we want to talk about navigating risk and opportunities. Does anybody in the audience have any questions so far? Right, good. So let's talk about hyperscalers hitting the pause button. Okay, the data center sector has been buoyed by a powerful narrative of relentless hyperscale demand, a narrative that has undoubtedly fueled significant investment over the last several years after COVID. However, recent equity research analysts at some unnamed firms has introduced a more nuanced, perhaps even cautionary tone, right? These reports highlight instances of major hyperscalers like Microsoft and AWS reportedly reevaluating their capacity needs, leading to some co-location lease cancellations or adjustments to their aggressive extension roadmaps. While these hyperscalers often describe their moves as routine capacity management or strategic pacing, these signals are nonetheless being closely watched. So Ellen, beyond the public statements, how these specific analyst reports and the underlying trend of hyperscalers potentially becoming more selective and adjusting their near-term commitments impact your conviction in the current market?
I would say people forget that this is a lumpy business. The last 2, 3, 5 years, it's been a one-way train that's been all in all the time in one direction. But historically, the data center industry has been lumpy. So I don't actually think this behavior is anything new. We've just been spoiled. So let's start with that. So I think it hasn't, obviously any pause impacts your conviction, but if you listen to Microsoft's last earnings report, for example, the business is quite healthy. They had record cloud growth. And so what we're trying to do is just find sites, having said all of that work for a number of different customers. It gets back to the infrastructure piece of the business. And I think if we feel like we have a good location with the right connectivity and power, it will be attractive. And if the industry's growing, some of these might start slowing down, but there's new entrants every day coming in, and so there's also customers backfilling.
And Tom, we talked about locations, so given these signals, are you reevaluating or refining your investment criteria? For example, does this shift your focus towards or away certain geographies for certain specific asset types? And does this now influence your return requirements and expected timelines?
Look, I think when you're assessing individual markets, I think let's focus on the European context as well we're sitting. I think we find that for our clients, Europe is a much more complicated space to kind of get our planning with certainty, with a footprint that's going to be right to build the type of hyperscaler facility. So I think I would say, most of the time spent by our clients or the platforms that we work for is really assessing what's the opportunity to build out the type of infrastructure that you want for the client that you want to capture at scale. And that's a process for which takes a bunch of time. You need to have a real sort of be on the ground. I think where perhaps 4 or 5 years ago, every new operator, let's say, I won't say name the names, but if they were entering a new market, they would go and do greenfield on their own. I think today we are more cautious and say to clients that need to enter a new market, let's say they're not in the Spanish market, let's say they're not in Madrid or Zaragoza. We would say, find a local partner who's already got power planning, or who's already got some local expertise to help you kind of land your footprint there, because going kind of greenfield over just you yourself is a much more risky proposition than it was maybe 5 or 6 years ago. And the kind of the markets of Warsaw or Madrid or Milan, Lisbon have just got, even Norway have got way more trickier to navigate. And so, if your build costs for it's $1 billion, there's so much more capital, so much capital to go around. You don't need to necessarily do everything yourself. So it's kind of a JV approach that we're seeing with people, and you've done that in Japan, you've done it in India. I think there's markets that will got that local nuance that you need to kind of take a bit more of a risk mitigation approach.
Giovanni, Alan says this business is lumpy. What are the key signs you're looking at right now to figure out if it is lumpy or if this is a temporary digestion phase? Or let's say, for example, is this just structural shift in the hyperscale demand patterns, or do you think they're probably targeting doing self-builds?
Yeah, I think first of all, the market is dynamic and coming from an infrastructure investor perspective. I think that's the key challenge around this market. You're not operating in a pure monopoly, not dealing with public counterparties, so you're dealing with businesses that are reacting live to geopolitical dynamics as well as local dynamics in terms of what demand they're seeing in their business. That requires an element of research and recognition of nuance in the market. Every market is different. Every market, every hyperscaler is approaching individual markets differently. There'll be a list of core markets that Microsoft is looking at, there's core markets that AWS is looking at. And so it's really making sure when you're entering into the space and assessing the market to build and operate in what is everyone else doing, both on the demand side and also the supply side. So that allows you to take a view of the lumpiness and when it may come, big demand factors. We're talking about projects that take 3-4 years to develop, so you almost do some forward gazing to a certain extent, but given the long development time, you are able to take a bit of a view as to what the competition is and what the demand drivers may be at that point in time.
Right. David, I'm going to put you in a challenging situation, but unfortunately not an uncommon situation, right? So imagine this. You've secured a pre-lease with a key tenant, the commitment is solid, and delivery dates are locked in. Then your utility provider throws a wrench in the works. They've just informed you that they can't meet the original power delivery schedule. Your tenant's moving date is now at a serious risk. As a developer, how do you navigate this crisis, and what are your immediate risk mitigation strategies to try to save this deal?
Thank you for surprising me with that question. I must say it's very kind. So what we've been doing at Echelon, for not answering Miles' question basically, is we've been building our own infrastructure. So Ireland is one of the most constrained markets from a grid perspective. So at our flagship project in Dublin, Dub 10, we built a 120 MVA natural gas powered energy centre for prime power. And I think that speaks to some of the challenges in the market, Miles, in terms of reliability of energy infrastructure. Building that energy centre is not easy. Probably one of the first to go operational energy centre like that in Western Europe. But certainly over the last 5, 6, 7 years that we've been investing in the sector, or I've been investing in the sector, speaking to colleagues in the US, they would have said to me, why are you building an energy centre? Just connect it to the grid. Well, people are very interested in our energy centre now from the US and also increasingly from Asia. So being able to navigate those constraints, whether they're regulatory, whether they're from utilities, is a key skill set. And I think, we're talking about M&A, we're talking about what makes platforms attractive. You go back 10 years into the sector, building 15 megawatts capacity was a large data center. You now have to have a broad skill set across renewables, across power delivery, across very, very large scale construction, and then across the ability to bring all of that together with capital and create something which is also scalable and can expand into other markets. It's a very, very different skill set that management teams have to have today compared to 5 or 10 years ago.
Thanks for that. Because as a major infrastructure investor, RDL faces increasing pressure on ESG performance, including firm net zero target dates. How do you assess the long-term viability and financial implications of strategies using significant carbon offsets versus those investing in direct emissions reduction, even if it involves challenging resources like nuclear? Is there a clear preference emerging in how RDM allocates capital based on the quality and realism of the decarbonization strategy beyond just capital?
No, I think it's a strong guideline in RDM since 20 years that the team exists and that has been throughout the various sector and now including the digital part. Obviously, data center is the underlying sector which consumes the more energy within the digital infrastructure space. But I think what we see there is also value to work on. We are also trying to reach net zero in the next next year. This has been clear guidelines when we invested into Verne, which is our platform in the Nordics, and we say to the point of talking before about latency, but I've done on inference, it's much more efficient from a sustainability perspective to have a large gigafactory of AI in a country where you have a lot of energy, where the energy is cheap, and where the energy is also green. So all these matters let us to invest into them. Now the question is, and we have seen also with the power outrage in Spain, can the renewable be the only energy source for those massive sites? Clearly, nuclear is a key pillar of the stability of the network and a key energy source to provide to the data center. So, countries in Europe which get decarbonized energy and get nuclear energy, including France, are super well placed in this AI race. France is moving too fast, is very ambitious. You have seen, I'm sure, the plan of President Macron back in February this year, where he gave out 10 billion of investment that at least on paper and provided, let's see how we see the conversion. So we see good traction from such type of country with a share of decarbonized energy very important. And I will also share one anecdote. We were speaking with a big operator recently, and they were speaking with a number of data center developers, and they told to a platform there, and they were the only ones speaking about ESG and sustainability. And clearly, I think that can be a differentiation factor, also from a tenant perspective, but also to accelerate as well the grid connection. So I think we are very keen on that thematic.
You guys invested in a company called Verne in Finland, and it's currently well positioned, and probably due to the significant power constraints we see in the flat markets, right? So looking ahead 5 to 7 years from now, when you have substantial investment targeting those flat power shortages, if successful, normalization could reshape the competitive landscape, right? So from an investor's perspective, what is RDM's core strategy to ensure Verne Finland not only delivers or even exceeds its target returns, but critically avoids becoming a stranded or underperforming asset as flat power dynamic potentially normalizes?
So, that's a question that obviously underperforming, I think.
Yes,
I was not expecting that question. I think the platform is more the opposite, is more overperforming. We see a huge demand from the clients, and to the point before about Hyperscaler, we see quite strong demand from the US client, but also from Asian clients. And we see you have been aware of TikTok looking at a number of capacities in the Nordics, but there are a number of also Asian players beyond TikTok that are very and super well rated from a credit perspective that are super keen on Nordics. So we see both from US and Asia and also Europe as well, a number of GPU services that are Europe based, very strong demand in the Nordics. So that's very positive for the platform. We want also to expand and open new country. We see markets like Denmark. I just spoke about France, but those are very interesting markets where Denmark should be 100% renewable energy by 2030. So there was a very ambitious plan from the Danish government to develop offshore wind, is a very attractive country for we have a big project in Norway as well. So hopefully this will be a huge success. And I can tell you we have many projects in the pipe on which we are working and trying to accelerate the development as much as we can from a clinical perspective, which is the main bottleneck.
On the other panel, we heard costs are going up, right, as a result of the trade tariffs, right? So, Giovanni, in recent years, data centers face rising construction costs due to factors such as post-COVID market dynamics, but also interest rate volatility, inflation, and supply chain disruption. So, given that rents are based on yield on cost, we've seen significant rent increases, with some supply-constrained markets experiencing up to 30% year-over-year growth, right? So, what is Macquarie's perspective on the sustainability of cost-driven rent increases, and what's Macquarie's perspective on whether these cost-driven increases represent a permanent shift in market run rates?
I think the first point I make is I think the lease rate increases should have gone higher over the past few years. I think that what has happened in the market is with infrastructure investors piling in with low cost of capital. I think that has covered up and absorbed some of the returns that should be really passed on to the end users. In terms of going forward, I think fundamentally, ignore all the AI hype at the moment and potential users. The reality is more data centers need to build and company exists just to meet the cloud growth and underlying growth in digitalization. There are still massive supply constraints in the market. We touched on grid constraints, development timelines, and challenges in various specific markets. And I think capital availability, although it's there at the moment, in a period where that is going to be in 2-3 years' time, just given the amount of capital that is being deployed in the space. So, fundamentally, we still believe in the space. I think what that means in terms of utilisers, I think they will continue to grow. We pass on to the clients, just because I don't think the supply side is quite catching up with the demand side.
Just add to that, Miles, perhaps. I think we've heard a lot about very attractive economics of the sector over the last 10 years, and sort of spread to the from development yields to investment yields. I would have expected that to compress over time, but the longer I've spent in the sector, the more I understand and realise how complex this sector is to deliver successfully. And I think what's going to happen is we're going to see over the next several years, I think, a wave of distress where there will be operators, there will be platforms which are relatively thinly capitalised, who perhaps fall upon the bell and got power, can't go from power plants to RFS and data centre. And taking into account the amount of developers who ultimately fail, then the returns that the developers who succeed are generating make more sense.
In the M&A landscape, are you guys seeing more creative deal structures or joint ventures designed to mitigate risk and access specialized expertise? For example, partnerships between data center investors and energy companies to secure power, or cooling technology providers for aid to the performance? Yeah.
Yes. Look, I think it's back to my earlier point around people who are approaching new market entrants with JVs. I think obviously that kind of if you can tie up with a local power company, using this in Germany to kind of accelerate your kind of grid connection time, that's a big positive. But of course, kind of the devil and the detail is around the JV structure and agreement and how you fund that. But certainly, I think, as I said, that was the previous answer. The scale of the equity capital and the capex you've got to deploy, there's so much. The pie is so big. There's no need to kind of tackle it all yourself. So I do think if you can find the right JV partner, it can be an accelerator. And we certainly do see, some of the power companies being, good operational partners, not just because they're bringing power and land, they've also got a sort of an internal skill set, think we haven't really talked about that much, but we see a shortage of kind of technical capability to map to all this piece of infrastructure over a period of time. So there needs to be a broader bench strength of just engineers. So if you look at kind of if you're building a 100 megawatt facility, you probably need 600 or 700 people to kind of finish the capacity. And so that creates a shortage of
This might be our last question because we've been told we have 5 minutes, but I want to make sure anybody in the audience can ask questions too. But Tom, how long have you been in business?
We've been at Torch 22 years.
22 years. So, Tom is the CEO of Torch Partners. We're a leading advisor of technology companies driving AI advancement, right? So, let me ask you, Tom, AI today is rapidly automating tasks, even decision-making processes that were once the domain of human consultants. So, could AI and its continued advancement disrupt Torch Partners' core business to the brink of extinction? And how are you, as a CEO, specifically preparing for this paradigm shift?
No, look, I think we're testing as many AI products as possible internally to try and automate the tasks that our junior team hate doing, so they can go out and drinking more. But look, absolutely, I think there's lots of opportunity that hopefully not get completely disrupted. Look, I do think when you think about the work that the operators do to build projects and bring them to market, there's still that kind of human connection that you need to build that trust up. The hyperscalers, why do they go back to the same people? Why do they go back to Cold again, or Vern again, or Ashore again? It's because they build capacity for them, they trust them. And I think the smart tool kind of AI is going to be to automate some of the work that you're doing. Fundamentally, you've got to build these projects at massive scale, and you go back to your partner that did it for you again and again. And I think that's the thing. Hopefully, we won't get automated away from this.
Does anybody have any questions? Well, here, I'm going to end here and ask each of the panelists to make a brief prediction of what they see over the next 2 or 3 years. Start with David. What do you?
I can start with what I hope to see a market for stabilized data center sales. I hope we have public companies or another source of capital. If you just think of the math in terms of all the returns and profits we've spoken about on the development side. It was mentioned this morning, there needs to be a takeout, and I think the industry will be all that has to evolve. And so that's my hope for 2 or 3 years.
What do you want to see?
I'm thinking, but I think I want to see operator being more, and looking again at other part of the digital fraud, like tools, and to make the variable with company like Seldex. They are now in the phase of very strong operational improvement, and I think, I'm sure that the market and the company which has developed massively over the last 5 to 10 years will come in the second stage to improvement in terms of operational excellence, and at the end, operational excellence is what will drive the ultimate return for the shareholder. And operational excellence will go as well with industrial excellence, about what we were speaking before about excellence, about the upgrading the data center. So that's my vision.
Yes, I have a great question for agency with being flagged at the time. Look, I think I'd like to see Europe take a leading role in kind of AI inference workloads being rolled out, and really building, if they want to take back some control from Trump, from Microsoft and others, that they need to go out, they need to be serious about building out infrastructure for the sovereign clouds of the the European context. That's what I hope to see. What I think we'll see is a bit of that, and then I think David's saying, I think we're going to see some restructuring for some operators that hit the wall.
Yeah, picking up on Tom's point, the lifecycle emergence of an order first like customer based fundamentally the emergence of European champions and state of our maybe some policy movements from the EU and the local government, but also enterprises adopting AI and digitalisation at a key point. And I think a bit more of a partnership approach between end users and the central operators, because I think that will take a lot of the let's say challenges out of the market in terms of trying to dovetail some developing programs in customer capacity in short order.
And I'd like to say something new. I think all those points are good points. I think we're also going to see a more determined effort by national regulators to unlock good constraints. I think that's going to result in take-or-pay arrangements. So I think you're starting to see that within the UK, and I expect to see that getting rolled into other European jurisdictions. And then I think on the capital side, we're going to have distress, there's going to be more public companies, and then I think we're going to see far more ABS within the European context to try to unlock financing on a stabilised basis. So more capital for everyone in the room, more capital, some more complexity in the operations.
Well, thanks. I can tell you what I wish. I wish we had more time, but we don't. But anyways, thank you again for attending our panel. And if you have any questions, we'll be outside the hallway. Thank you.